Thanks for checking out this video from NetPicks, and we're going to talk about swing highs and swing lows. What are they? Simply price action points in an instrument where the asset's value reaches its peak before reversing direction. That's a swing high. So this can happen on any time frame chart, intraday charts, monthly charts, it doesn't matter. Swing highs and swing lows are really important technical tools that we use to identify trends. Now, the opposite, of course, of a swing high is a swing low, and that just marks the lowest price point that was reached before price moved in the opposite direction. So these 2 points form what's known as an inflection point or a trend reversal pattern on a chart that can be used to anticipate future movements of price. Now, swing highs and lows, usually determined using candlestick charts, that just displays the data for each trading session over time periods ranging from minutes to weeks to months, okay? The candle actually represents 4 different pieces of information: the open, the close, the high, and the low for that particular period. Whether it's a day, week, minute, doesn't matter. So the difference between the opening price and the closing price forms either a red candle if it closes lower than it opened, or a green candle if it closes higher than it opened. That's going to indicate whether there was buying pressure, which is green, or selling pressure, red, that dominated that period. The highest point during that session is going to be marked by the highest high, and the lowest point is marked by the lowest low on this chart here of Tesla. So these points, they represent potential points where price may bounce from support or resistance levels. So this trading day ended up to be in a trading range as price closed inside the high and low zones of that day. So why do they exist? They exist because it's a natural part of market behavior. And whether we're talking about stocks, forex, commodities, it doesn't matter. Prices are always fluctuating as buyers and sellers take action in that instrument. Swing highs and lows, they're created as a result of these price fluctuations, and they really do represent important points where the market has changed direction. So the market's going up, swing highs are formed when the price reaches a peak before reversing course and heading back down. Swing lows formed when the price reaches a bottom before reversing course and heading back up. Traders are going to use the swing high and the swing lows to identify potential support and resistance levels in whatever you're trading. We can also use those to confirm trends and potential reversals. So for example, if an instrument is going up, traders may look for the swing lows to identify potential entry points for buying. These swing lows could act as support levels, preventing price from dropping further. Let's say the instrument's in a downtrend. They may look for swing highs to identify potential entry points for selling. These are called resistance zones. Traders will also use previous swing highs to take profits at when they're in an uptrend. Same's true for previous swing lows during a downtrend, because both of those can act as either support or resistance going forward. So as long as there's more buying interest in the instrument, price is going to continue to make higher highs and higher lows. Because traders are buying at higher prices, sellers are unable to take control and push too far to the downside. So overall, swing highs and lows, they are an important part of technical analysis and trading. These can provide valuable insights into potential future price movements. Let's touch on fractals. Fractals are just a set of repeating patterns that occur in financial markets. They can be used actually to find probable entry and exit points, as well as speculate on the course of price movement. So fractal analysis is just based on the concept that all market activity is cyclical, meaning it's going to repeat itself over time and on different time frames. So a fractal pattern consists of 5 consecutive bars or candles. The highest high is at the center, got 2 lower highs on either side. The lowest low also appears at the center with 2 higher lows on either side. So this creates a W or an M shape when you put it on a chart, and that's why they are often referred to as waves or mountain tops and bottoms. When this pattern occurs, it usually signals a change in the trend direction from bearish to bullish or vice versa, depending on which way price moves after forming the pattern. Now, fractals in trading, they're a pretty powerful tool. When you're looking to recognize patterns and trends, it can allow you to make better decisions when you're trading. You have more information. So how do we find trends? Well, so these points on a chart, the highs and the lows, they indicate when the price of a stock is reversing direction, either up or down. When you can recognize swing highs and lows, it's possible to identify trends. Again, why do these swings exist? Because the answer lies in human psychology. Humans we tend to act similarly under similar conditions, regardless of whether we're trading stocks, options, commodities, currencies, or anything else. When people see price rise rapidly or fall, they become more likely to buy or sell. This will cause more buying pressure, obviously if you're buying, or selling pressure for selling, and that will drive prices even higher or lower. So eventually this cycle will reverse itself as buyers become exhausted, sellers enter the market again. So this is going to create what we call a swing high and a swing low on the charts. These patterns are going to repeat over multiple time frames. It's going to enable you to pinpoint potential areas where support and resistance levels could form or where breakouts could occur. This knowledge is going to help you make better decisions based on your analysis of price action, rather than just blindly following a technical indicator. So again, using swing highs and lows, you can identify trends, and that may be needed for your particular strategy. So how do we use it in a strategy? Well, we can leverage swing highs and lows in a strategy. We can use them to identify areas of support and resistance, as well as potential entry and exit points. So the first step, got to find them. Swing highs are created when price moves higher than the previous high. Similarly, swing lows occur when price falls below the low point. So this is going to create an area of support or resistance that could indicate a trend reversal or continuation depending on which direction price moves in. So this chart here, this is swing highs and swing low indicators found in the TradingView charting package. So once we've identified these points, it's important to consider what type of trade you want to make, buy or sell. So if you think the trend is going to continue in its current direction, then buying at a swing low could provide good returns if the market goes up. You want to sell at a swing high, could be good if price continues to fall, but we want to see a continuous stair-stepping type of pattern of higher swing highs and higher swing lows for an uptrend like we see here. On the other hand, if you think there may be an upcoming reversal, then entering into positions just before this occurs at either side could also prove profitable depending on how quickly the market reacts after you get into the trade. We would call this counter trend trading. It's a trading skill you can learn. There are some rules that you should follow when trading it. So let's say you found a trending instrument. We want to see a classic breakout and pullback scenario. Price is going to break a swing high and it's just going to pull back to the former swing high zone. If a reversal happens from there, we could plot an objective swing low depending on how many candlesticks you need in your own pattern, right? So this indicator is set to 5 candle pattern. It's adjustable, right? You can make it 3 if you want. Price pulls back to a former swing high zone, and then we look at the 310 oscillator in the bottom panel of the chart. We want to see that slower line to be trending upwards, and that's going to indicate bullish momentum. Now we can use a flat line, but what we don't want to see is it curling to the downside when we're buying. Now look at the fast line. We can see it hooked to the upside. We place a buy stop order above the candlestick that turned it. Stop loss goes below the low point prior to the reversal. Pretty simple. We can use technical indicators like Bollinger Bands, other averages, relative strength index to help confirm possible breakouts from established range. Wrapping this up, it's pretty simple. When you understand how trends form, when you can identify them on a chart, and you can use them as part of your trading strategy, you are going to increase your chance of success. It's that simple. But again, as with any type of trading approach, you got to remember swing highs and low, those strategies, they come with risks as well. So make sure you do your research before you put your money at risk here. And we talked about indicators earlier. We just talked about using price action. So let's look at price pattern trading. This is a free guide. It is our most popular guide we've ever given away. You can learn how to trade patterns with accuracy. You could find ideal entry points. It's a free guide. Link is to the left or it's below in the description. Again, it's one of the best ones we've ever given away. Talk to you soon.